This is Don Kaufman, and you are watching the TheoTRADE evening video, August 16th, 2023. SPOOs are off yet again, some 30 handles. Nasdaq taking a hit down, almost 1%. Got me asking the question, are AI stocks bubble popping? Or is this just going to be like simply another buy the dip scenario? Let's actually break some of the trade action down. I think you guys are going to find this evening's video maybe a little bit surprising in terms of what's actually leading some of the sell side activity and where specifically some of my concerns moving forward happen to be. One of the first things I want to point out before we start talking about big tech and AI, before we talking about buy the dip, push all of that aside for a second. Here's one of the more disconcerting areas of the marketplace. That happens to be the progression of the S&Ps right now lower. In fact, I'll tell you what, I'm going to zoom into it here just a bit. When I say the progression of the S&P is lower, look, it's just this easy. We're trading, up in the neighborhood of 46.25. Here we are right now. I mean, lo and behold, we've now lost 200, S&P handles or 200 SPX points. Now, why the cause for concern? Take a look at volatility. Now, granted, volatility has definitely bid up from some of the more recent lows, right? We're trading in and around 13.5. All right, vol takes off to the upside. But one of the points that I really want to stress before we talk about any, possible buy the dip, I don't like what I'm seeing in terms of implied volatility. And yeah, I'm using the VIX to kind of designate this, but what do I not like? Well, you just saw that the S&Ps are presently at, some recent lows, but the volatility is not, at some of the highs. Now, we didn't close at like an 18 vol. Up here though, we did actually close in and around the 17 handle. What I don't like in this marketplace is that the volatility, and I've said this time and again, it feels suppressed. My assumption is a very, very simplistic one. Every time, that market sees some sell side activity, which was prevalent yesterday, which is prevalent obviously today, volatility starved animals are rushing into the marketplace to sell premium. Why? Just because they haven't seen any in quite some time. Again, we've just come out of a summer where, again, vol was meandering, maybe 14 was like the best vol you're going to get, a little quick spike up here. But yeah, this is some of the best volatility we've seen. And I want to be incredibly cautious with my approach. Now, I'm not giving you, a directional bias with this. My caution is simply, I've seen this movie before. They come in and they sell vol, and they come in and they sell vol. And the lower the S&Ps go, the irony, volatility is actually subsiding. It's like the marketplace is just kind of sinking into a warm bath. There's no pressure against the market. I'm going to further that concept by saying this. If you take a look at the S&Ps, and again, I'm zooming in, but the reason I just expanded out volume here is that quite simply, the volume out of yesterday, we didn't even do 1.5 million S&P contracts. It's like a nap the market's taking right now. Look, S&Ps, we're rocking to the downside yesterday. Right now, as we speak, we're approaching the lower edge of the expected move. Market's still open. It's got a few minutes left, right? We're approaching the lower edge of the expected move. There's no punch in the vol. There's no punch in the volume. The other thing that was really surprising, so I'm talking about S&P, futures, and some of you are like, I don't really know. Like, here, what's to know about the S&P futures other than when you have a big day in the marketplace, you should expect to see volume kind of rocking, and it's just simply not. And again, that coincides with the fact that volatility isn't picking up. The point that I'm trying to make, and you couple all these things together, and I saw option volume yesterday. And again, yesterday was a big day. I mean, look at the range. We're trading, 45.18. We're all the way down here, let's call it 44.50. When you have like 60, 70 handle days, you expect volume to be rocking. Moreover, option volume yesterday was only 43 million contracts traded. You're like, I have no idea what that means. 43 million contracts, but average contract size in 2023 has actually been about 44 million, which means you have this rocking day yesterday, but we did below average volume on the S&Ps, right? Lackluster, I should say. Below average volume in terms of the option marketplace, okay? And the VIX is just, got this suppressed feeling. Again, the cause for concern is it's suppressed until all of a sudden it absolutely explodes. All I'm trying to get you to see is that, look, we could buy the dip. Like, I don't want to express, which direction do I think the markets are going? I'm going to explain that in a moment. I'll give you an opinion in a moment. I don't want to express about like buying the dip or not buying the dip yet. What I want you to understand is that when you're seeing sell side activity like this and volatility is not like erupting, okay, I think it's cause for concern because this can pounce all over you, especially if you're a premium seller and you're not prepared for it. Meaning that all of a sudden, you're selling off, and the market just punches lower, okay, and we erupt into volatility land. That would be my best, interpretation of what's presently going on in there. Now, okay, we're going to talk a little bit about the idea of a buy the dip. One thing that is very apparent, or a minute into the bell here, one thing that is very apparent, bonds, they're getting annihilated right now, which relates, of course, to interest rates. Yeah, that's the 10-year, and that's a 9-month. Okay, I'll open up a 10-year chart. That's not enough. Okay, you really have to open up a maximum chart in this particular case. Max chart. By the way, the SPX is going to close directly on the lower edge of the expected move. Okay, it's beautiful. We'll show that in just a moment. Back to the 10-year. 10-year is all the way back to 4.25, which, okay, from a closing point of view, and again, I'll open up like a 3-year just to show you this. From a closing point of view, we're basically at, okay, highs on rates. So here we come into the cash close here. SPOOs down, another 34 handles. That was beautiful. Show you why in just a moment. So we're basically right at or near closing highs of interest rates. Okay, so who cares, right? What's the cause for concern? The cause for concern is you want to buy a dip in this. Okay, right there. And we talk about buying the dip. I think this this dip buying idea is dead until the bonds have to actually turn back to the upside. You want to see a dip buy? Is interest rates have to cool off. Bottom line. Now, here's the one thing that actually has also kind of caught me off guard. We're going to take a look at the financials. In terms of financials, look at auto expected moves. Auto expected moves just give us a really good feel of like what's the leader in the pack to the downside. The financials, okay, are outside the lower edge of the expected move. Bear with me here for a second, right? Go over to the energy sector. The energy sector, okay, breaking down a little bit. It's outside the edge of the expected move. Meanwhile, cruise over to the QQQ. Now, the Nasdaq last week hit the lower edge of the expected move. The overall marketplace didn't. This week, though, okay, Nasdaq's only halfway home to the lower edge of the expected move. Meanwhile, if you take a look at the SPX, yeah, you knew I was going here. We're home, okay? So, and again, look at this on an intraday basis, all right? Effectively, we closed within, less than 6 points away from the lower edge of the expected move. It's absolutely uncanny, like how you have a $4,400 product, okay, that misses this expected move, okay, by mere basically pennies in this circumstance over here. It's like a rounding error, if anything. So the one aspect, again, I really want to stress this week is the breakdown this week is much more about energy. It's much more about the financials. Meanwhile, really big picture with the interest rates, okay, flying it. By the way, inverse relationship. As interest rates go up, obviously bonds go down. With bonds down, rates up, if we're going to see more sell side throughout the course of this week, okay, it's going to come specifically from big tech stocks. We're at this point right now is, look, you take a look at those financials, they got whacked yesterday, okay? Today, basically unchanged. You take a look at that energy sector, it's had 2 horrendous down days. From this point forward, if we're going to push lower, okay, on specifically Nasdaq, right? It's going to be some of this Magnificent Seven. It's going to be the NVIDIAs, okay? It's going to be Microsoft, which I've been talking about, a very pivotal 320 level. It's right there, okay? Pay attention because this, people, is the first time that kind of all those stars have aligned where interest rates, that's not helping the marketplace. Volatility looks suppressed, looks like it's about to explode higher. Okay, so you got interest rates coupled with volatility. Then you start looking at other major sectors. They're down. They're not out, but they're definitely down. Now, okay, the remainder of the week, yeah, it's all about tech. And we're looking at it like, the AI kind of bubble popping. All right, that's exactly where we're at for the remainder of this week. Forget about buy the dip. Even if we rally, okay, at this point, it could be very, very short-term relief rally. Now, okay, we watch the Magnificent Seven to see if those sellers start coming in, because if and when they do, oh yeah, this marketplace is primed to get ugly. Thanks everybody for joining us here at TheoTRADE. Have a wonderful evening. Bye-bye.